Good afternoon, everyone. Thank you for tuning in today. My name is Carolyn Margiotti, and I'm a member of the CFA Society San Francisco, as well as being a board member for the Society and serving on our finance committee. It's my pleasure to welcome you here for today's webinar, the 2025 Market and Economic Outlook. Our speakers today are James Demmert and Michael Firestone. First, I just want to note a few quick items before we start. The audience will be muted for the event, so we encourage you to type any questions you have in the Q&A box. We will monitor the questions and endeavor to answer as many as we can, primarily at the end of our discussion. The event will also be recorded, and we will share the replay after the call. Now, I'd like to introduce our esteemed panelists. I am joined today by James Demmert, the founder and chief investment officer of Main Street Research, a registered investment advisor serving individuals, families, and foundations. James is an accomplished investor with over 35 years of investment experience, as well as an award-winning author of 3 investment and finance books, including his most recent Wall Street Lessons. Welcome, James.
Thank you.
I'm also joined by Michael Firestone, founder and managing partner of Fire Capital Management. Michael is an experienced investor focused on the ultra-high net worth and family office space, along with private foundation, OCIO, and consulting services. Michael has served as the president of the CFA Society Miami Board of Directors and as an adjunct lecturer at Florida International University. He currently serves as the co-chair of the San Francisco Foundation Professional Advisors Council. Thank you, gentlemen, for being here today, and let's get started. So as you know, we are coming off a very strong year for the U.S. equity markets, with the S&P 500 up 23% in 2024. I believe the Dow Industrials gained about 13%, and the NASDAQ Composite was up a whopping 29%. This followed a strong year also in 2023 of 26% for the S&P 500. Of course, there were a lot of ups and downs amidst election uncertainty and geopolitical risks, as well as many other factors. Could you start by giving your view of the 2024 market to set the stage for some of the primary factors that might be shaping your outlook for 2025? James, would you like to start?
Sure, I'd love to, Carolyn. And I think that's a great way to sort of frame where we're going to go today, looking at that last 2-year period, which was basically twice the annualized rate of equities over the last 100 years. We had a dynamite couple of years. And, in many ways, I would suggest this is textbook what you get when you start a new business cycle. So we're of the view that we're early in a cycle, and that cycle really kicked off by, getting past the disequilibrium we had. As many of you know, we had inflation at 10%, a market that was trading at a pretty high multiple, and all of that came down with the Fed doing their work, raising rates. So they effectively put inflation back in the barn. And it did create that bear market, which was almost 30% in big indexes and 40% or more in tech. And when you go through those disequilibriums and you get the inflation or whatever is wrong with the economy back on track, typically what happens, you have a lot of cash on the sidelines and people recognize, the economy is now in better shape and stocks are reasonably priced. And that's when you get that off to the races, big push into the equity market that's driven by earnings, Fed policy reversing from tight to loose. And more importantly, and I think this is an important conversation as we think about 25, you have a tremendous amount of cash flowing into the equity market that pushes past even the earnings growth. So you get these astronomical returns. It's pretty common in the first 18 months, let's say, of a new business cycle and a new bull market. So, that doesn't surprise us. And boy, it's been generous. And of course, it's got the AI tailwinds, which I think creates even a little bit more exuberance. So that's kind of, we think, what gets us where we are. And of course, it's going to be different in 2025.
Great, thank you. Michael?
Yeah, I mean, I think I'd summarize last year just in a couple words, right? Like better than expected. You really think, and that's really not just us at Fire Capital. You really think back to what the Wall Street forecasts were across the street. I mean, really at the high end, low teens, on the low end, maybe -10, -12%. That was really across the board. There's actually a really great Bloomberg article out recently talking about how economic forecasts and market forecasts are futile because they consistently get it wrong. But last year was really interesting, right? Like there were some big surprises. US real GDP really spiked well further than what consensus estimates were. I want to say the estimate beginning at the year, it was something like 1.2, 1.3%. We're going to end up with something like 2.7, 2.8%. Huge beat. Corporate earnings, maybe not as big of a beat. And granted, those numbers aren't in yet. We're still getting them with this earnings season, but more likely than not, better than expected. You really think about something that's driven that, at least from our perspective, labor force productivity. I mean, productivity in the US has been frankly on fire for the past, I'll call it 2.5 years coming out of the pandemic. There was a little bit of a dip. And then really since then, it's been well above trend. And that to us has made really quite a bit of difference. I'll also highlight just 3 really big surprises, at least for us, they were surprises. I think for most folks investing assets, they were surprises. Obviously, the emergence of AI, and not just the emergence, but I'd say the second order effects down the supply chain and how much spending has kind of come in that's really affected the broad economy. And I'm sure we'll talk about market concentrations and things of that nature, but you've got the biggest companies in the world spending billions of dollars, well above what was expected. Clearly, that's going to have a positive impact on the economies that they're working within. And for us, we certainly think they did. The other piece is the fiscal side. There was a lot more aggressive fiscal spending last year than we had expected. A lot of that actually offset some of the restrictive monetary policy that was in place. It kind of filled the gap. The third, which to us might be the biggest surprise, and frankly, I'm still not totally sold on it yet, but I'm coming around to it, is just the lower sensitivity to interest rates for the US consumer and the US economy. Historically, you have a Fed hiking to combat, you usually get a recession. Actually, it's been 60 years since that has not been the case. And it's looking like, and from what we can tell, we're not in a recession now. There doesn't appear to be a recession, at least in the near term. And, you know, I mean, that's meaningful. And you think about the bifurcated economy, right? Like we've heard so much about that, you know, in the news, the haves and have-nots, the folks with assets that have benefited from price appreciation from stocks, from real estate, those that are lower income, usually younger, have suffered more. Inflation hits them harder. They also have more debt, student loan debt, car debt, you name it. And those interest rates have hit them harder. But the cohort that spends more, at least for the broad economy, did quite well. And then coming out of zero interest rate policy, you've also had a lot of rates locked in, mortgages, even corporate debt.
Great, thank you, Michael.
Yep.
So considering some of the comments you made in 2020 on 2024's markets, you both have touched a little bit on this, but what do you see being different in 2025 in the markets, and what factors are you currently focused on? Michael, do you want to, or sorry, go ahead, James.
No, go ahead, Michael. You can
Yeah, I'll just keep the train of thought going, I guess. You know, one, expectations are very high, right? So we came into last year, as I mentioned, expectations for US GDP was something in the range of 1.2%. This year, as we head into 2025, expectations are in the 2.2, 2.3 range. So almost double. So meaningful. Corporate earnings expectations are much higher, looking at the 14, 15% range. And clearly there's a lot of optimism about potential policy shifts on the pro-business front, tax cuts, things of that nature, that have really pushed, I think, the needle a little bit further. So those expectations, of course, when expectations are higher, they're potentially harder to beat, but that doesn't mean that won't happen. The other piece kind of entering this year is it's no longer the emergence of AI. AI is here, and we're talking about the potential amount of spending that we're expecting over the next few years. I think Capital Group put out a stat recently, something in the 500 billion range for just, I think it was Alphabet, I want to say Amazon, Meta, and there's one other one there that's escaping me, but just massive amounts of spending where it's no longer of a, hey, is this happening? There's real money going into the economy. And the last piece I'll just highlight briefly is just interest rates. Last year, the consensus call, I think, was that rates were going to continue to fall across the curve. That is not happening currently. Rates have spiked. And actually, you're seeing a lot of flip-flopping around of what that call actually is going forward, and whether it's due to economic growth increasing, whether it's inflation long-term, or maybe it's partly due to the budget deficit.
Great, thank you, Michael. James?
Yeah, I could touch on a few things, and I like what Michael has expressed. Let's remember that part of 23 and 24, investors are recognizing this is not just a normal business cycle, it's an AI-driven one, which has a tendency, these technical transformation cycles tend to create higher productivity growth, which is why I think the economy was more resilient than anyone expected and probably will continue to be. Higher profit margins. We're just doing more with the same amount of infrastructure, which is really good for economies. And what fueled the market in 23 and 24 was all of that, plus all the cash and the Fed policy. What we think is really different in 25 is that you're losing a couple of those rockets, those turbochargers. One is you're losing the cash that was sitting around in the sidelines because a lot of it's now been exhausted. And you're also, very important for investors to recognize, you're losing, I think, Fed policy. Coming into this year, we know we have higher productivity growth, very resilient economy, and you got a very pro-growth administration. And the Fed's kind of got inflation where it wants it. And I think they're going to be really, really careful about cutting rates any longer, because that probably could ignite inflation and get them back into trouble. So our view is, without rate cuts and without all that cash, what happens to stocks? And our view is they trade on earnings. But one thing I think is really important for everyone listening in, I talk to my clients about this, these AI or any kind of technology transformation decades like the 90s, they tend to be periods where earnings and market returns are higher than normal. So instead of the 9 to 10% returns we've seen over the last 100 years, you get closer to 12 to 16% returns for equities, particularly in those companies that have that margin expansion. A good example of that would be the 90s. I think there is an analogy that can be made there. And let's keep in mind, during that period, we did have returns excess of normal averages, closer to 15% annually with lots of bumps. But also we had a 10-year yield at 6% throughout the 90s. And so this market can trade higher in 24, not the spectacular crazy numbers we saw last year, but in 25, we think we could probably do 12 to 16%. That's why our target is 70-50 on the S&P. And it's going to be fueled by earnings. We're not going to have the benefit of some of that other stuff, but still very attractive risk return. More volatility, more normal corrections. It's going to be bumpier. So get yourself emotionally prepared, maybe prune the big winners of last year. But we think it's a very good setup with a few risks, which we'll talk about later in our conversation.
Great, thank you. Just to continue on that, you both touched on earnings, which I'd wanted to ask you about. Obviously, they've been strong for U.S. companies in recent years and helped propel the market last year. I've seen earnings projections to this year anywhere from 11 to 14%, basically around what you're talking about, Michael. I think yesterday we saw the kickoff of earnings season with the major banks announcing significant profits and beating earnings across the board. I think the S&P 500 ended last year with a forward PE around 21.5, which is above historical averages. So thinking about some of the perspectives you've already talked about and what you're seeing in the markets today, what's your certainly earnings can support valuations to some extent. What are you thinking about the current valuation levels of the market? Michael?
Yeah. So, seems like this is going to be a call about productivity, because I'm just going to mention it again. I just feel like it's so important. And just to kind of back up what James said previously, the productivity levels that we're seeing, especially in recent quarters, let's say the last 8 quarters, we haven't seen since the 90s. Before that, it was the 60s, right? And that really raises the bar potentially. It adds to the potential for earnings to exceed expectations even further. And it's amazing that we've been able to kick out these earnings, and not just strong earnings on an absolute basis, but margins in particularly are quite high, well above historical averages. And that's in the face of high interest rates, that's in the face of high inflation. So all of that is really quite meaningful. From an absolute valuation perspective, yes, valuations are high. Valuations aren't a great indicator of future returns, at least in the near term. Over the longer term, certainly, maybe we can kind of readjust our longer term expectations. But I mean, what I would say there is that you're seeing a lot of, I think, strategists, economists, market folks compare what's happening now to previous bubbles. And effectively, when you look at the valuation ratios, we're nowhere near that, right? Like you compare it to the tech bubble, you compare it to other periods of time, we're not close. What I will say on a price to sales ratio aspect, or a revenue basis, the markets are clearly valuing revenue at this point in time. That is the one, I guess, well-used valuation metric that is in that territory of previous euphoria. But outside of that, I would argue that there is opportunity for upside. Now, the flip side of that is risk. And having high valuations certainly adds to the risk spectrum, because the higher you go up, the further you have to fall. That's just reality. And you highlighted it well. We're above trend, even in recent times. And you take into zero interest rate policy, all of those years where valuations arguably were higher than long-term trends, and we're still even above that average. So the risk spectrum, I think, has widened, and it is something that investors need to be aware of. On a relative basis, it tells a little bit of a different story. So for the first time in 20 plus years, you look at the S&P earnings yield relative to the US corporate bond yield, or yield to worst. It's the first time they've come to parity. I think it's 23 years, early 2000s. So the relative attractiveness of stocks versus bonds has gotten to that point. Now, that doesn't indicate that everybody run to bonds or anything like that, but again, it does speak to the risk side of the equation, which again, I'm sure we will get into later on this call.
Great, thank you. James?
Yeah, I think we look at valuation a little bit differently in this market, because this market is different. If you look at, as we all know, the last 18 months, the Magnificent Seven, that's where you have real high multiples. And the fact that they make up so much of the capitalization of the indexes, we try to strip that out and look at historically, what the heck are the other 493 stocks trading at? When we do that, we see like almost stocks that are abnormally inexpensive. So it's bifurcated. We all know that. And I think there's a message there that if this is a real beginning of a new business cycle, which we think it is, we're in our second year. They usually last 7 to 9 years if they don't get derailed. We see a market, I know we've all been anticipating this broadening, but we do think once investors realize the Fed can't raise or lower rates because the economy is too strong, we think that's when the rest of the market catches fire on the upside, And people go to the valuations that are very inexpensive everywhere else besides the Magnificent Seven. So I think investors would be, it would be foolish not to own the Magnificent Seven, but you definitely now want to start to own all that other stuff that's got very reasonable prices, hasn't really gone up that much. And we think it will catch fire on the upside as we go forward, particularly here in 2025.
And following up on that, couple things. One is for both of you, given the concentration with the Magnificent Seven, how do you manage that? And we don't have to go broadly into risk management yet, but just thinking about the Mag 7, how do you manage that across client portfolios? Is that an issue? How have you been dealing with that?
Go ahead, James.
James, maybe to start.
Yeah, I'd be happy to start because it's something we've been doing recently. We big proponents. We were overweight tech, recognizing the transformational situation going on. And I think that the risk management that we've been using in that Mag 7 area is that we sort of said to ourselves, a lot. If you break down some of those companies, they're at the picks and shovels part of AI. Let's say like an NVIDIA, where we recently sold a third to a half of it because we owned it for a few years and it had done so spectacularly. And the reason we did that was managing the risk of not just that stock, but the risk of maybe, the opportunity cost maybe to own something else. Because our view is some of those companies, certainly are going to do really well, maybe better than the market, but maybe not as well as some of the second derivatives of AI, like some of the software companies like you see in ServiceNow or Palantir and that area of the market, or even Salesforce. So, I think you manage the risk by recognizing and commuting with clients that, the trees don't grow through the sky, pruning back some of the biggest winners in the view of, hey, maybe the rest of the market broadens out and we should take some of that capital and put it somewhere else. So that's really how we've been, just recently starting to finally, prune back, if you will, that magnificent exposure. But we're still, those positions still are relatively big compared to the rest of the portfolio.
Yeah, and I'll just add to what James mentioned earlier as well. I mean, I think it's really difficult not to own the Mag 7 in some shape or form. Most investors do through just a simple S&P 500 ETF. So you have that concentration risk built in. I think it's awareness, it's understanding what you own. It's also recognizing that there's risk there. I mean, it was just a little over 2 years ago where we saw tech sell off. Meta was down 60%, NVIDIA was down, Amazon was down, big numbers. If we're concerned about global issues, tariffs, for example, here, from a policy front, these companies get a lot of their components from international places. So their supply chains are heavy international. They also get a lot of sales internationally as well. So these investments aren't riskless, but the trend has been in place pretty much my entire career, where we've seen Microsoft, we've seen Apple, we've seen all these companies continue to beat the odds, outperform, and the scale that they have relative to their competitors, it's unmatchable. They're modern day monopolies that aren't considered monopolies. So in terms of risk management, of course, like diversification comes first, and how do you diversify? And we can talk more about strategy later, but for us, we have broadened as well. You think about equal weighted S&P and things like that, just to broaden some exposure there. You look outside the US as well. But what I'll say though is, last year was a big year. Half of it was fundamentally driven, right? The other half was multiple expansion. That's not true for the rest of the world. But the other piece of that, in terms of the fundamental piece, is the Mag 7 not only drove returns, it also drove a huge portion of earnings contribution in terms of what actually pushed it higher. So again, I don't think you can stay away from it. It's concentration risk. And just as I kind of opened up with, the second order effects of those companies investing really across the chain down has had major effects. And if that pulls back, it'd be hard for me to see that that wouldn't have an effect broadly.
Great, thank you. And you mentioned the, doing equal weighted indices, things like that. Is that something that your clients, some people might welcome it, some are wary of pulling back on the big winners, right?
Yeah.
How do you talk about that with your clients, Michael?
It's challenging, right? And particularly for taxable clients. I think James said it earlier. We've also owned NVIDIA for quite some time, right? Triple, quadruple. The cost basis is quite low. And you're selling a winner that's continued to be a winner, and not just a winner, the winner. Um, so it is challenging, but at the same time, I think we, at least at Fire Capital, for all of our clients, have a dual mandate. It's not just maximize returns, it's also minimizing risk and downside. And again, I do agree with James that there probably are opportunities outside of the Max 7, even going down, the cap table, maybe those mid and small cap companies. At the same time, pretty consensus call, I would say. Maybe late summer, everyone's saying go into small caps, interest rates are going to fall, big driver. That has not happened. And we've seen some pullback. Actually, small caps are in correction territory right now. Again, it's that balance between opportunity, being aggressive, and diversifying on the downside. And yes, buying those lower valuation companies really serve that purpose.
Great. Anything to add, James?
Yeah, we recently pruned back our NVIDIA position, so it's a good time to chat about that. And for some clients, it was like taking candy away from a baby. Why would
I'll
you do
bet.
that? And part of I think part of our business, if we work with private clients mostly, is to communicate, and that's an art in these kinds of situations. And one of the things that I think we used in our tool bag was like, look at the last market correction we had, and the market went down 8%. I think it was in July, and NVIDIA went down 20. Reminding people that as that position got bigger and bigger in your portfolio, and normal volatility comes back, which we think it will. This stuff is, and I do anticipate that we'll have a 10% correction or something this quarter. And I'm trying recognizing to clients and sharing with them that these positions are really going to, yes, long-term great investments, but for the diversification of the portfolio and standard deviation, cutting it back by a third is just going to feel better as we go through those generations. And also, let's put that capital maybe in a place that has is good or better growth going forward, because NVIDIA, and the new Blackwell chip is fantastic, but the baton is going to be handed over to another group of companies that, again, as I mentioned earlier, who've invested in AI, whose valuations are lower, so they have a lot more room to grow on the upside. So there's a bunch of stuff there that you can kind of unpack as to how we are managing client expectations.
Great, thank you. Following up on the question about valuations and your thoughts, I have to ask if you have any predictions for this year for the S&P. You can say the S&P 500 if you have thoughts there. You can say the Dow. You can say Bitcoin, wherever you might have a directional view of the markets going forward. Maybe Michael?
Sure. Yeah, I mean, we don't do price targets or things of that nature on big markets. There's a lot of folks that make a lot of money to do that, and they have a ton of resource. And as I kind of opened up with, they still get it wrong. It doesn't mean that they're not valuable, because they certainly are. Understanding where consensus is, understanding where expectations are, certainly helps. I'd say directionally, and again, this is reliant on a lot of things given high valuations, but directionally, I do agree with what James said earlier as well. I think tracking earnings growth, maybe not getting more multiple expansion here, although still certainly possible, is a reasonable outcome, whether it is 11 to 14%, wherever we end up by the end of the year for US markets. I think a lot of the other stuff is really dependent on potential policy, and I think that's going to be a first half story in terms of fiscal policy. I think it then shifts back to monetary policy in the second half in terms of all right, now how is the Fed going to deal with all these new policies that have been unveiled if they are majorly different and significant change, or maybe they're not as aggressive as what's being communicated right now. Yeah, I mean, I think globally there are opportunities, and there's been much said about the relative difference in terms of international developed equities and the valuation gap on a historical basis relative to US companies. I would point out emerging markets as well. You know, you look at last year, the emerging markets multiple contracted, 100% of it was fundamentally driven by earnings growth. There's a lot of talk about the strong dollar, and does that continue to get stronger? You worry about historically debt crises and things like that in emerging market countries. But I think the argument today, which we somewhat subscribe to, is there's been a lot of learning from central banks in terms of those debt crises. Some of those things can get managed. But yeah, to me, there's a lot of question marks around policy that are going to drive the potential opportunities, at least in the next 6 months, over do we really want to kind of go outside of the US or not?
Great, thank you. James?
Targets, pretty straightforward. We're 70-50 on the S&P 500 by the end of 2025. I think we're like one of the highest on the street. Related to all the productivity growth earnings that I mentioned earlier, pretty much no Fed in the way. And 6 years from now, we have 15,000 on the S&P, and our favorite hat in the firm is Dow 100,000 by in the next 6 years at the end of the business cycle. That is if it doesn't get derailed, you know, that's a whole nother. But we think that's what can happen in this, you know, AI transformational economy.
Great, thank you. We've touched on this a little bit, but moving to rates a bit, after I believe 3 rate cuts in 2024, the Fed indicated there'd be fewer coming in 2025. As I think Michael might have mentioned, I think some of that's even, or actually James, I think maybe mentioned that, you know, it's not maybe even cutting anymore. It might be you just stopping cutting or even moving up. And given the recent moves in the bond market, I think yields across the yield curve are all pretty close to 5%. Do you have concerns for businesses just on borrowing costs? And how do you see sort of the converse? So not necessarily getting the rate cuts, but also just if yields continue to climb and that impact possibly impacting equities negatively. What are your views there? Maybe James to start.
Yeah, I mean, our view is that yields have risen, even though the Fed is, you know, evidently was in cutting mode, because the market is saying the signs ahead for the economy is going to grow stronger than expected. That's what we think is the premise for why rates have gone up when the Fed hasn't really touched them. And that means that corporate profits can be resilient to higher yields because of the strong economy, back to the 90s analogy. But that isn't necessarily so for all companies. And I think we're going to learn this quarter, you know, because rates have gone up. I'm interested in Regions Financial, which is a regional bank, which is going to report on Friday. You know, those smaller banks, that might not be a good thing for them. So that's why I think 2025 is a very stock selective market. I don't think you can just buy an index fund to do real well. And I think you got to be careful about stepping into potholes like that, where rates are higher, but not really, it's a headwind for some of those smaller banks. So I'm really interested to see what comes out of that. And I think investors should, you know, again, use higher yields as a sign, hey, the economy's great, but, you know, that does have a negative impact on certain businesses, and you want to be kind of avoid those.
Okay, thank you, Michael.
Yeah, I mean, I'd just say historically, right? Like risk assets in general are sensitive to higher rates, particularly bonds. You look at the sell-off we had a couple years ago, meaningful for the 60/40 portfolio. But in addition, I would say that I think we would argue that that R star or that neutral rate might actually be higher than what the street believes or has believed for maybe the past decade or two.
Mhm.
It's possible, right, that structural changes post-pandemic, deglobalization, all the onshoring, the nearshoring, all the things that we're experiencing now has structurally pushed up that growth rate, has structurally pushed up that inflation rate, and that, maybe we are back to a more normal type of economy than what we had gotten used to for so long. It's funny, like while we were in zero interest rate policy, all of the talk was we're getting addicted to low interest rates. This is going to be a problem, et cetera, et cetera. And you look at the impact of higher rates now, at least on big corporations. Yes, it matters, but again, as I mentioned before, corporate profitability is doing quite well, much better than we had expected at least. And that's in the face of all those higher borrowing costs because they can borrow at very long rates, and they did borrow at very long time periods at very low rates, right? So the actual net interest expense, once you add on new debt, is relatively low. So it really doesn't hit their bottom line that hard. Now, small cap's different, right? Like if you're a smaller company, you're not taking out 20-year debt. Can't. You're taking variable rate 3, 4, 5-year loans, and it really does affect what I would call the real economy, the smaller companies, the mom and pop businesses, even what we would call smaller cap companies nowadays. So to James' point, it definitely depends, but net on the aggregate, higher rates haven't proved to be an issue, and with corporate profitability being so high, the impact here is and potentially an offset of corporate tax policy changing. The impact has been minimal. Now the tail risk that we were all talking about a year ago, 2 years ago was commercial real estate debt. A lot of those forbearances have continued to get pushed out. That still needs to get refinanced, a very large chunk. And obviously that does affect banks and pension plans and very large pools of money. But that doesn't really seem to be on anybody's mind right now, but it's still something to be aware of.
It's a good point. Thank you. So the elephant in the room that we haven't really touched on is the change of the administration and tariffs. Seem to be what a lot of people are talking about. Can't seem to talk about anything else. So thank you for giving me sort of broad thoughts. And I know it's early, but just given the new presidency, likely policy changes that might be coming down the pike, specifically tariffs and others. What investment themes do you see as particularly promising this year, and why? Maybe Michael, if you want to start.
Sure. So when I think about potential policy shifts, deregulation seems to me to be the clearest kind of path to playing out the way that we expect, particularly in the energy and financial services space. So increased M&A activity, I think some of those investment banks are going to do quite well going forward. On the energy side, and you also have the AI tailwind, which is massive, right? We're talking about this AI spending, the data center build out, the effects across all those other companies that James mentioned in terms of chips, in terms of components and parts needed to do that. I mean, the energy need to power these things is off the charts. That doesn't necessarily mean, hey, let's go buy a ton of fossil fuel. I think that was really the call the first time around when President Trump was elected, was financials and energy. You look back, fossil fuel energy, and granted we had a pandemic, but fossil fuel energy actually performed quite poorly, and renewables performed very well during his first administration. With that said, I personally feel it's not just, hey, let's drill, baby, drill. That's the full mantra. It is a full energy need, and nuclear is becoming something that is gaining steam. It's a company called Constellation that was spun off by Exelon recently. They're the ones that are in charge of that 3 Mile Island project that Microsoft has kind of restarted. And there's also a lot of other small modular nuclear plants beginning to get permissioned and going through the process. So we think that could be an opportunity. You know, on the tariff side, the tariff is tough, right? Because is it a negotiation tactic? Are we going to do blanket tariffs across the world? I think from the administration's perspective, from the president-elect's perspective, there's no reason to hold back in terms of what he wants to get accomplished. However, the guardrail is that he has a very slim majority in the House. And the Freedom Caucus in particular, that subsection of the Republicans, they are very, very budget focused. So you add in tax cuts, it becomes tough without offsetting that maybe with tariffs, but there's a gap there in terms of that money coming in. So I do think we're going to be fairly aggressive, or the administration will be fairly aggressive on the tariff side, but it's also going to be pointed. Right? You think about EVs, for example, and other renewable components from China. You know, Mexico seems like a threat for other reasons. We'll see. There's all kinds of different pieces to this. So we're certainly not investing around that quite yet, but we recognize it as a risk.
Great, thank you. James?
I can touch on that briefly. And Carolyn, I love your comment of the elephant in the room. I don't know if that was purposeful, but you should say the mule or the donkey. I kind of go right along with what Michael's saying. I mean, this is a huge thing for dereg, and it lights the financials on fire. The only thing I would probably add is the industrial sector with a lot of infrastructure plays, and there's a lot of value there where multiples are really low. And I do think that, this is the analogy of Trump walking around with a big stick, to try walking tall with a big stick to try to get a better negotiating, rather than really using the tariffs. But we're global. We were 26% foreign, and before the election, we got it down to 16 by parsing out where we thought the vulnerabilities might be for targeting of tariffs. So I think it's something we do, we've been cautious about it, but we'll be more than happy to go back up to 25, 26 if we can get past this portion of it.
Yeah, and just to contrast that, I think we're at about 11% global or international ex-US. The rest is domestic. So leaning in pretty hard to that US exceptionalism story. And then just to add one more that I forgot to mention, like we've talked a lot about AI. So didn't want to go too hard into it, but I do want to highlight, I do think there's a very big difference from, let's say, the picks and shovels that James has highlighted versus those companies that are trying to roll out consumer products. You've seen it start to play out already, right? Adobe with Firefly and their consumer product, Apple's AI intelligence so far has fallen flat. But that 500 billion just from those 5 companies I mentioned in CapEx, and a lot more coming in the AI, that money's going somewhere, being spent in various different places. So there's certainly opportunity in that area.
Got it, thank you. The touching back, we touched on rates quite a bit, but are there opportunities? I mean, rates are rising. Are there opportunities that either of you are seeing in the bond markets, just given sort of what we've been seeing over the last couple of weeks, over the last 6 months? How are you thinking about the bond markets currently? Michael?
Spreads are tight, really tight. And I'll kind of make the equivalence to just the high PE multiples in the equity markets, right? If this continues, you can make money for sure. Absolute rates are quite high. And if rates come down, even better. The way that bond convexity works, right, is you get 100 basis points up or 100 basis points down. Your asymmetric risk is actually, you're in a really good spot. You're going to make more money if rates get cut than you're going to lose if rates increase. Now, that's all to say that it depends what your view is on fixed income. I mean, for us, that's our defensive bucket. That's what we use as diversification. If we want equity like risk, we can go out 30 years, be super aggressive, and hope rates come down. But that's not necessarily what our mandate is, particularly in that side of the portfolio. We've had We have added a little bit to mortgage-backed securities in recent time to extend our duration because we've been ultra short in the short end, worrying about that second wave of inflation. To James' point, maybe it's not that, maybe it's economic growth longer term that's pushing the longer part of the curve up. Term premium has risen. I would argue that part of that is the budget deficit issue. But for us, like, I think there are opportunities if you get it right, but we talk about this internally, like interest rates and currencies for us are some of the hardest things to get right in investing. So we really don't try to put huge bets around those things. And just like we saw last year where the consensus call was rates are coming down, anybody who went ultra long is really losing their shirt right now.
Right. Thank you, James.
Our view is that Fed watching is going to become really boring and a non-event. I mean, I don't think I've been in the industry for 35 years. I don't think I've heard the word Fed more in the last 2 years than I did in my whole career. And I think that's over with. I think that rates are going to be in a trading range, anywhere between 4.5 and 5.5. And this is a fabulous environment for the balanced account, 60-40, 70-30, where, on the fixed income side, we only use individual bonds. You're getting, close to 5-6%, depends on corporates or treasuries, and clip those coupons. And just, that's the foundation of the safety part of the portfolio. And don't try to be, it is what it is, and it's fantastic. And then you've got, 12 to 16% in equities. This is the kind of era, that people will talk about later on. A great combination of fixed income returns and equity returns. Again, if it's not derailed, which we'll talk about probably today.
Right. Thank you. We talked a lot about U.S. equity markets, talked a lot about U.S. equity markets. I want to make sure we have time to touch on opportunities outside the equity markets, outside the U.S. You both have talked a little bit about your global positioning. So maybe we can talk a little bit more about that explicitly on some of the investment opportunities you're seeing outside of equities. James, maybe if you could start.
Yeah, we've been primarily U.S. and foreign stocks and both U.S. and foreign fixed income. The only part of the real estate market that we've gone to, we only use individual securities, so no funds, is we own real estate investment trusts in the digital area, like digital realty. Beyond that, we really are fans of liquidity and transparency, so we don't really own alternative investments per se. So we're sort of old school, and that's working. So
Great, thank you, Michael.
Yeah, it's hard to argue that because it has worked. And what I'll say is that we invest across publics and privates. It depends on the client though, right? The gap in your top managers or top strategies and your bottom managers or strategies versus the public and the private side it's a mile long. So you really got to be good at picking those right managers to execute the strategy that is in the right place. So it certainly adds up, adds some more variables. Again, client specific, we have private mandates that we are effectively carrying out that are still diversified, just like we would on the private side, or I should say on the public side. What I would argue is that the public equity market is a very, very small component of the investable universe, and it continues to shrink over the years. So the number of publicly traded stocks has fallen meaningfully, and the number of private companies has grown. And so we believe that there are opportunities outside of public. You just got to be really good at getting them right, or very particularly on your risk and due diligence side as you go through it. On the public side outside of US, as I mentioned, like we're quite underweight in terms of international equities at the moment. With that said, I did highlight emerging markets earlier. Maybe a little bit of a contrarian call. We do have a slight investment or called bet in China, also a little bit contrarian, recognizing the structural issues, recognizing the debt issues, also looking at the valuations, also recognizing they're still growing at 4.5%. and that there's a ton of stimulus being dumped into those markets. Really Asia broadly, right, in terms of the EM side. So I mentioned the fundamental drivers of returns last year. All of the returns from the EM side, particularly Asia, was driven by earnings. None of it was multiple expansion, which is much different than the rest of the developed world. So if you're looking for value, to me, there's opportunity there. Does that mean Japan? Does that mean China? Does that mean Taiwan, India? Maybe it's all of the above.
Great, thank you. Switching gears a little bit to risk management. I'd love to hear a bit about how you approach risk management in your portfolio allocations with your clients, and what strategies you might employ to navigate some of the uncertainties in the current financial markets. James, would you like to start?
Sure. I mean, that's a big part of our brand. And frankly, I think it's one of the most important components of generating wealth over the long run is mitigating the risk, any of these catastrophic declines that usually come with bear markets, or come from, one company falling apart like a First Republic, or a whole sector getting decimated. In our view, there's 3 steps we sort of implement on everything we do, including my family's assets, which is A, have a flexibility to reduce stock exposure in the face of a market that's falling more than normal and with some negative information. So that's unusual because a lot of people are kind of set it and forget it, 60-40, 70-30. We're not that way. Fortunately, you don't really have to use that flexibility very often because bull markets are most of the time. And then being very sector sensitive, I think is important. Stay in the sectors that have robust earnings outlooks. Stay away from those that, potentially have a negative implication for whatever changes are going on in the economy. And here you have, the higher rates. We talked about that, what sectors are negatively impacted by that as a way to manage risk. And then lastly, a tool that is available to all of us, doesn't cost anything, and nobody usually uses it because they have bad experiences, but we are active users of employers of stop loss orders, and they're very carefully placed using some math, art, science, so that they're not close. So they allow for normal volatility in each individual security, but they are there to basically create a discipline to mitigate the catastrophic decline. And that discipline is really about my last book, which is called Wall Street Lessons. It's creating a discipline to stop our own psychology from saying to ourselves, oh, it's down more than normal, I'll wait till it goes back up, or oh, it's down again and now it's too cheap to sell. These are all the things that as humans we sort of apply to situations that go from bad to worse, and that's where catastrophic decline comes from. So, the stop loss mechanism, the discipline, basically just stops us from, getting, even as professionals, down that terrible psychological spiral. Yeah, that flexibility of asset allocation, the sectors being that, and then stop losses are there to protect us.
Great, some great ideas. Thank you. Michael?
Yeah, I mean, we start with the philosophy that it's you really need to be aware that you don't know everything. Right? I mean, it sounds simple, but you really have to have a strong appreciation for that. And things happen. James highlighted the regional banking crisis, right? There was a pandemic. There's always something, and it happens more frequent than we like to remember, I think. I think that's a big piece for investors. With that, also diversification, whether it be sector aware, security aware, asset class aware, paying attention to those correlations, although they do break down during systematic issues and financial crises. But to take it a step further, we have regular risk management meetings monthly. We look at things like factor analysis. I'm not a big believer in using factors for, let's say, opportunities, right? Like I'm not trying to load up momentum, for example, or things of that nature. But for us, it's being aware of where we are currently sitting, and also being aware of the types of companies, asset classes, strategies that we own, and how they interlope or interact with each other. So we do stress test our portfolios, and then at times when options are cheap and buying protection is cheap, we will buy protected puts on the S&P 500, considering for the majority of our clients, US exposure is the biggest exposure that we have. So it depends from time to time if we're gonna do that, but at times we will put on protection. It's like an insurance policy for us.
Great, thank you. We're coming up on about 5 on the hour, and we do have some questions coming in, so I'm going to switch to the questions. The first question is, with conversation of broadening, I would love to hear a view of the healthcare given underperformance and the real headwinds facing the sector from policy uncertainty and focus and lower international growth. Who would like to take that?
I'll jump in on that one, and if Michael wants to chime in, that has got to be the most unloved sector. I love the question, and if I had to only own one sector over the next 5 years and put it in a closet and just not look at it, it probably would be healthcare. In our view, it's got everything against it right now. You've got pricing regulations, and I think that's why the GP1 makers have fallen recently. I mean, that was our only place that there was actually some growth. But our view is the stocks are unbelievably cheap, and they're almost hated, and they're becoming such a small part of institutional portfolios. So valuations are really historically low. And I think the key here is that no one has the patience to see what AI is going to bring. And we think that AI is going to maybe have the most impact. It's just you have to be patient because it takes longer to seep in. But we think it's going to have the most and particularly important impact for us as humans on the planet on healthcare. So I like to invest in things that are trending upward. So that made a big commitment. But that's probably the place that we are keeping a closest eye. We think there's going to be incredible returns over the next 3 to 5 years.
Yeah, I mean, post-election, healthcare just took a nosedive. And our head of investment strategy did some work around election years and came to the conclusion that healthcare is always doing poorly around election years, yet we stuck with our overweight. And for the same reasons that James kind of highlighted, right? We do feel that AI is going to benefit the space. We feel that valuations are fair. We feel that cash flows are strong. There's parts of healthcare, say biotech, namely, where it's more event-driven than market cyclical driven. I think there were some events recently, the unfortunate murder of the United Healthcare CEO. You have RFK Jr. stepping in, which has kind of caused some waves in terms of how the healthcare system could be upended. But in terms of election seasons, at least in recent memory, it's not like there's a big Affordable Care Act bill being passed. It's really the lowest on the totem pole in terms of noise around healthcare, yet it's still getting hit. So we actually do feel the same way, that it's a great place, and also a great diversifier as well, if we're talking about routing out risk that also has upside.
Great, thank you. We have time for maybe one more, one, possibly two more. Can James speak a little bit more about opportunities in the US small cap market? How do we identify winners in this climate? James?
Yeah, I'll go quick because we don't have much time. And it's easy because we don't have any exposure there. But I think that we might have more exposure when we sort of see more broadening. And our view there is you're going to have to really go where they're not sensitive to interest rates. I think tech is going to be where we're going to focus, in telecommunications and possibly healthcare. Those are the 3 sectors. But right now we are a zip in the small cap area.
Great, thank you. Well, I think we've gone through the questions and we're coming up on time. So I want to thank everyone again for joining us today. And especially like to thank our panelists, James Demmert and Michael Firestone, for their time today and their thoughts on 2025. I've definitely enjoyed our conversation. So thank you, everyone, and have a good afternoon.
Thanks, Carolyn. Thanks, everyone.
Thanks, Carolyn. Thanks, Michael.
Yeah.